Welcome to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
Ian, what's up, buddy?
What's up, man? I never realized our intro music has "Let's Go" in the background.
It's got applause and all kinds of stuff. So next show we actually have a new intro. So
shit.
So it's you'll be surprised. Welcome to the Real Estate Reserve Podcast, everybody. Today is Friday, February 12th. Depending on what part of the country you're living in, you might have some snow and some cold like we are. The guest that we're going to bring in a second lives in sunny Florida, so it's the complete opposite. I'm sure he's got way better weather than we all have here locally in the Northeast. So we're going to be talking about 1031 exchanges and everything kind of in between with that. It's a super hot topic that's going on right now. Obviously, we have a new administration. What has changed since, or what are the plans that will potentially change with this new administration? So we're going to talk about 1031s. We're going to talk about basic strategies. We're also going to get a little bit more in depth in advanced strategies. So don't worry if you're a newer investor, you don't know what a like-kind exchange is. We'll get into that. But also, if you're an experienced real estate investor and you own multifamilies, you own commercial, and you own other assets, we definitely want to get into some more advanced strategies as well. And I think Ian and myself are going to learn a good bit as we go through this.
Yeah, I'm listening to you. It turns out Facebook, since we've done our last event, REI Badness, has changed the share settings. So it's a little bit more difficult. It's going to take a little bit more time. For those of you that attended or missed it, we still have some stragglers still donating, which is awesome, to the Metro Burn Foundation. So hopefully next show we will have an update on how much will be getting donated. It was an absolutely awesome event. We interviewed all different types of asset classes. And actually, this is a really good follow-up show with Justin to discuss what it looks like for tax advantage strategies, because you do get into flips, or you do buy a rental property and then you want to get out of it a few years later. How do you but how do you manage your tax liability going forward? There's a lot of hot button items with current administration, state specific stuff. So we're going to get into all that. Super excited. So I think the only best thing to do besides me and you talking is to bring Justin in.
Sure. Hey, Justin, how are things?
They're good. Thanks for having me on, guys.
Appreciate it. Absolutely. We appreciate it. So what I was told by Justin before he gets started is he does have to do a little bit of a disclosure because he is a financial advisor. So why don't you do a little intro about yourself and go through that disclosure real quick, and then we'll get into some fun stuff.
Yeah, sure. So so this is the downside of being a financial advisor. We deal specifically in real estate, but I am a financial advisor, and so it's a heavily regulated industry. And so we have to be kind of careful about what we say. And so, just to jump through this disclosure and we can get to the good stuff. Anything that I say here is for informational purposes only, does not constitute as individual investment advice, and should not be relied upon as tax or legal advice. You're going to hear me say that a bunch. I'm not a CPA. I'm not an attorney. So I apologize in advance for how often you're going to hear me say that. Please consult the appropriate professional regarding your individual circumstance. Investments in real estate may carry risk. DSTs, those are Delaware statutory trusts, are speculative, illiquid, carry a high degree of risk, including the potential loss of the entire investments. Investors should read the risk section of the private placement memorandum for full disclosure of risks. Potential cash flows, returns, appreciation are not guaranteed, could be lower than anticipated. Any securities are offered through Concord Investment Services. That's our broker-dealer, member FINRA SIPC. And my group, Fortitude Investment Group, is independent of Concord. So that's the boring stuff. I apologize for that. My name is Justin Kiehne. I work for Fortitude Investment Group. Like I said, we focus on real estate. We deal a lot with tax-deferred, tax-advantaged real estate investment, fractional real estate investment. Lion's share of our business comes in through the 1031 exchange, obviously. My group does about $250 million annually in a specific type of 1031 exchange transaction. So I'm psyched to be here with Jason and Ian and kind of talk about the 1031 because obviously, it's been in the news lately with, as Ian said, the new administration and Biden having some thoughts and things of that nature. So we can jump right in.
Yeah, I would say the first thing is to, I guess, is let's jump into it. For those that don't know exactly what a 1031 is, before we even talk about the other stuff on the backside of this, what is a 1031 and how can you, I'm assuming only real estate investors use that to their advantage?
Sure. Yeah. So 1031 exchange, it's also known as a like-kind exchange. And there's some confusion around the term like-kind, but the like-kind exchange has been in existence for, if not 100 years, pretty close to 100 years. We're talking about the 1920s when this stuff came about, in some form or fashion. Up until 2017, you could do a 1031 exchange on a lot of stuff. Nowadays, it's essentially only real estate. The term is real property, but for most folks, that effectively means real estate. But what it is it's a way to defer your capital gains taxes. And Ian said it best. We're not avoiding taxation, right? We are managing our tax liability. We're deferring our taxes. We're not avoiding. We're not ducking. Nothing we do here is under the table. We're not pulling the wool over anybody's eyes. The 1031 exchange specifically gets its name from Internal Revenue Code Section 1031. It's written into the tax code. But what it allows is for an investor to sell a property that is highly appreciated, reinvest the proceeds from the sale of that property into other real estate, and as a result, not pay capital gains taxes. It allows you to keep your money, your gain, your capital gain in real estate and working for you. And obviously in real estate, we talk about cap rates, right? It's five cap, 10 cap, whatever. And so if you're going to defer taxation and you're able to reinvest $500K instead of $350, a 10 cap on $500K is obviously larger than a 10 cap on $350. And so that's why it's really important to know about. And it can be a really powerful tool.
Yeah. And just so people know, and if I'm speaking out of turn, please let me know. But if you're flipping a house and you don't own a house for a year, you cannot utilize 1031 exchange. It's for long-term capital gains is what this is specifically written out for, correct?
Yeah, that's correct. And there's a little bit of gray area there, but the rule of thumb is essentially a 1-year hold, not a flip. Think rental properties, right? You don't do it with your primary residence. There's another piece of the tax code that deals with, eliminating capital gain on your primary. So this is only for, business real estate or investment real estate intended to be held.
Right. And then I guess the other thing is, so when you were talking about like-kind, and I know this is where it gets real weird, and I even have trouble conceptualizing it, is that if I bought a property for, let's just use round numbers, $1 million, I took out $500,000 of debt. 5 years later, I sell that off, has $400,000 of debt, and it's worth $1.2 million. When I go to buy that next property, do I have to buy another property at $1 million with similar type debt, or do I need to buy that same property a 1.2 with no debt or debt? I guess.
Yep.
You know what I'm trying to add.
Yeah. So the way it works, and there are obviously rules around it, and some of the rules are pretty strict, and there's some timelines involved too that we'll get to. But in your scenario, you're kind of hypothetical. Let's say you bought for $1 million and you sold for 1.2. To perform a full exchange, to get the full tax deferred benefit, right, to not owe any taxes on the transaction, you have to buy for equal or more than what you sold for. So if you sold for 1.2, you have to buy for at least 1.2. You also have to replace any debt. So in your scenario, and I mean, just to keep it like really simple, let's say it doesn't matter what you bought it for. Let's just assume there was gain on it, but you're looking to sell it for $1 million, and you have $500,000 in debt. So you're 500 equity, 500 debt, selling for $1 million. Looking to do a 1031 tax deferral. When you buy the next property, you have to buy for at least $1 million, and you also have to have at least $500,000 in debt, right? You have to replace the debt that you relinquish when you sell with new debt on the next property that you're buying.
Okay. Yeah, that makes a lot of sense. And when they say like-kind assets, if I own 10 rental properties, single family, and I want to exchange it for a storage property, when they're talking like-kind, are they talking about asset for asset, or are they talking about real estate investment for real estate investment? I can't 1031 that into a business, like a lending business or something like that.
Right. No, that's a good question. That's another kind of point of confusion that we get a lot. People think like-kind means like single family for single family or like land for land. That's not the case. It just means investment property for investment property. So we get, and like I said, we deal specifically in this fractional ownership structure. So a lot of times we'll have folks 1031 exchange out of a rental condo, into a piece of commercial real estate. We see folks that sell multiple single family homes, and if you time it right, you can sell multiple single family homes and 1031 exchange into a single multifamily asset. We have folks that sell pieces of land that maybe they inherited or it's highly appreciated because the local municipality is expanding. So they'll sell land and they'll exchange into something that cash flows for them.
Question for you, and then we had some questions that came in that we're going to get to here in a second. Does the investor need to, let me think of the best way to phrase this. Does the investor need to roll over every dollar from that sale, or just the taxable amount? And you probably get the question, but I can explain a little bit better.
It's the full amount. So
let's say I buy a property.
Yep.
So let's say I buy a property for $1 million and I put $500,000 into it, and I have $500,000 in equity. Now let's say my basis increases, right? Because I improved the property, I put another $200,000 in cash into that, right? So and then I sell it for, let's say, 1.2. So technically, so I make 200. Let's just say I make $200,000 profit. Does the 200,000? Like, can I just roll over the 200,000, or do I have to roll over the 700,000, which is the
if only.
Exactly. So that's where it gets tricky.
Yeah. So the 1031 exchange, kind of eliminating any numbers or any calculations for full tax deferral through a 1031 exchange, you have to roll all of the proceeds from the sale. Doesn't matter what your basis is. Doesn't matter what portion of it is gain. You have to roll all of the proceeds from the sale into the next property. We get that question a lot because obviously people are, looking to pull some liquidity out. They're looking to cash out a little bit, things like that. We deal in opportunity zones as well. For anybody that doesn't know what an OZ is, those came out in 2017 with the Tax Cuts and Jobs Act. They have some of their own sort of tax incentives that are separate from 1031 exchanges, but they allow a little bit more flexibility. In an opportunity zone, you only have to invest the gain to get tax benefits. In the 1031, it's the full amount, and that's one of the biggest differences.
Got it. Okay, so I think I have a better way to phrase this as an example for everybody listening. So if you buy a property for $1 million in cash and you sell it for 1.1 million, technically you have $100,000 in income that you would pick up, right? And then you have to make that decision. Do you want to roll that entire 1.1 over to your next project? Or do you just want to pay the tax right now on the $100,000
and take the same debt?
Okay.
The big thing though is you have to take the same debt, right? Like if you took a $500,000 loan to do that deal, you're trying to get debt free, or you want to live that lifestyle, or whatever it is, you still have to take on that $500,000 of debt moving forward. And that's actually a question I was going to ask you is, let's say we have a gain we wind up and we have to go buy a property for 1.1 in Jason's example. But we know in 6 months that we could refi that and liquidate through a refinance. Are we able to disperse capital in that or return equity in that way without having a tax exposure potentially?
So that's a question for a CPA. I told you I'm going to say that a bunch. That's a question for a CPA. I certainly see clients, folks, institutions, whatever. I see them 1031 exchange and then refi. I work with some groups that, have done that. I don't know what the timeline is. I don't know what the magic number in terms of how long you wait is before, the IRS doesn't view that as a red flag. I can say that the 1031 exchange, the intention is, that you're reinvesting and you're keeping that money in real estate.
Yeah, that makes sense.
Let's go. I'm going to pop Rich's question up on the screen. He has a few different ones, so hopefully we can follow.
And Justin, welcome to the show. We're going hard as hell in the first.
I love it, man. I'm having a good time already.
We got a bunch of questions, some bullet points, but this is better. Real life examples are better anyways. So, okay, let's see if we can follow along.
Oh, here we go. Check this out.
So question on a like kind. Let's say I own 10 condos that I paid $1 million for and I sell them for 1.5. Can I sell and then buy 4 $400,000 homes for 1.2 million, as long as I trade up on cost. Also, my debt is a line of credit, so it can be 0 one day, 800 the next.
I hit a follow-up.
Let's go through his follow-ups first so we get the whole story. Then, as I understand it, there's required increase of debt load, which is why I asked that line piece. And in my example of the above line of 800,000 over the 10 assets, so if I buy four $400,000 homes, in theory, for my debt to be 800,000 plus would require a simultaneous line across all.
So my understanding here is that he has a line of credit, and the whole and it's either a personal line of credit, so it's not associated with the homes.
Probably.
In which case, and again, not a CPA, but in which case I would say that the debt is not associated with the property itself. Obviously,
it may be. It's probably a commercial line. It's probably a commercial line of credit collateralized by each property individually.
Okay, that's a little bit above my pay grade. What I can speak to is so if he sells for 1.5 and he buys for 1.6, that's perfectly fine. You can go up in value. You can inject extra debt. You can inject extra equity. You can absolutely go up in value.
And you can buy multiple properties.
You could sell a single large asset and buy 10 properties with the proceeds. You could buy, you could sell 10 single family homes and buy a single large asset. So long as the timing works out, because there are timelines, and I've mentioned that a couple of times. So the way it works is from the day that you sell your property, on closing day is day 0. You then have 45 days to identify, and you have to identify your replacement properties or your potential replacement properties. And to make it even more fun, there are some rules around how you have to identify. All it really means is that you write down on a piece of paper, the addresses or the descriptors of the properties that you're looking at and considering, and you turn it into, the qualified intermediary who's helping you with the exchange. But there are rules around it. So after your 45 days to identify, you then have another 135 days to actually close on your replacement properties. So it's a full 180, 6 months, which goes by faster than a lot of folks think.
Yeah, you hear a lot of people in the marketplace. Actually, we bought this 76-unit apartment building, which we've covered a few times on here. And a few months in, we had a guy up the street that out-of-state investor, New York money, on a 1031 says, I'll pay above what you paid considerably more. And we're like, well, This is starting to get real. But I guess he was so constrained by his 1031, it was worth overpaying than it was to take that tax burden on in the face, which was a really interesting proposition. And I think maybe that's where the DSTs step in a little bit, that some people can protect against this if they don't want to be constrained by the time, or they want an easier way to invest when they're backed up against the wall, right?
Yeah, and we see that a lot, unfortunately. And the situation, that you never want to be in is the one where you end up buying poorly because you're time constrained, right? And we've mentioned it a couple of times now. So the DST, very quickly, that it stands for Delaware Statutory Trust. This is an investment that is suitable only for accredited investors. If you guys know what that means, it essentially means $1 million in net worth, not including your primary residence, or you meet certain income thresholds. But the DST is a fractional ownership of institutional quality real estate that is managed by a very large real estate company, a sponsor, and it qualifies for 1031 exchange. So that's the lion's share. What my group does is DSTs for our clients. We have a preset menu of DSTs available kind of at any given time. And so we have clients that call us up who want to identify the DST as a backup option, knowing that they can reserve equity, so they don't end up in a scenario where they're pushed up against a deadline, whether it's the 45-day or the 180-day. And they don't end up in the scenario that you just described, where somebody's willing to overpay or buy poorly because they have no other options.
And with that DST, and we can talk about more of that in the future as well. But is the purpose of that to roll into that vehicle and then to roll back out into their next investment?
So you certainly can. It's not a short-term hold though. So and we get that question a lot too. It's not something where you 1031 exchange into it for 6 months and then you 1031 exchange out of it because, the market has cooled off and now you feel like you can get a better buy. No, you're in the DST for the life cycle of the investment. And that's going to depend on kind of what the strategy and the asset class is. So a DST might be a $100 million multifamily property. You might be an investor that has, $500,000 in sale proceeds. And you can buy a piece of, $100 million multifamily property. And maybe it's a class B with a slight value add strategy. And so they're going to, update the countertops, redo the bathrooms, new appliances, and look to sell in 4 or 5 years, but that's never a guarantee that you're going to get out in 4 or 5 years. But, you, the investor, are in it for the life cycle of the investment.
Right. And I guess another point to the DST versus, I know we're about to get into OZs because Jason wants to ask you about that, versus 1031. 1031 and OZs allow you to do a lot more value add, comparatively speaking, when you invest into a DST. It's a little more of a hands off, I'm chilling. It's not a super value add play, right? And I think there's laws against it, right?
Yeah. So the name of the game with DSTs is really, and there are risks with any real estate investment. And one of the risks with DSTs specifically is illiquidity. Like, you are a passive investor, right? You don't have voting rights. This isn't something where you can wake up one day and call your realtor and list it. You're in it for the life cycle of the investment. But the name of the game is really capital preservation and income. You're going into a DST because you're performing a 1031 exchange and because you no longer want to deal with tenants. You no longer want to deal with maintenance. So as a part of that, there are some rules against what DSTs can and can't do. One of those rules is significant capital expenditure. So you're not going to get a DST that's a multifamily property that is 50% occupied, that needs new roof, total gut job, so it's not one of these sort of speculative or highly value added scenarios. Most of the DST, and I keep referring to multifamily just because it's easy. Most of the DST multifamily properties are going to be, low 90s occupancy, and they're going to be institutional quality, and they're going to have a cash flow. And obviously the intention is to increase NOI over time. But it's not, you're not going to double your money in a DST.
Gotcha. Makes sense. Hey, if anyone's listening, feel free to ask questions, share this broadcast. I'm glad we got a lot of viewers, a lot of followers on here right now asking questions and just listening, kind of tuning in from home, because this is a pretty advanced strategy in general. This is a little bit different than a lot of the stuff we talk about, just buying one-off rental properties, fixing houses, flipping houses, things like this. So I'm glad everyone's following. Again, any questions that you have, feel free to comment below. So let's go through this. I think this is probably Aaron Foster who posted this, and it just says Facebook user because he probably did it through one of our Facebook groups. If you do it through our Facebook page or our YouTube channel or LinkedIn, it'll actually populate your picture and your name. But either way, thanks for the question. So, okay. So can you roll 1031 money into an opportunity zone?
So that's sort of a broad question. You can roll any capital gain into an opportunity zone. And roll is probably the wrong word. Roll implies, you're performing a 1031 exchange, or you're performing like an IRA rollover or something like that. You can reinvest capital gain into an opportunity zone, no matter where the capital gain comes from. Could be a sale of stock, could be sale of art, certainly can be the sale of real estate. And so I guess if the question is, hey, I 1031 exchanged into a property, and now I'm going to sell that property, can I invest those gains into real estate or into an OZ? And yeah, the answer is yes. You get, you can reinvest and get the tax deferral.
And judging by we're pretty sure we know who asked the question, is that Aaron, the point is that you don't need a 1031 into an OZ, right? You can, your goal is to invest in the OZ indifferent to the 1031.
Separate from, right.
And that it's the same process, it's the same thing, but it's not that the 1030, you're not 1031ing into an OZ. Right. And just, I don't know if you want to get into, maybe, can you describe some of the parameters in OZ and how that tax benefit works inside of an OZ?
Sure. Yeah. So the opportunity zones came about, qualified opportunity zones came about in 2017 with the Tax Cuts and Jobs Act. It was, President Trump's first first tax legislation, and it was actually a bipartisan effort. So people concerned about Biden coming into office and sort of rolling that back or eliminating it. It was actually a bipartisan effort. And if you recall, in 2016, the expectation was that Hillary Clinton was going to be president. And so the expectation was that this opportunity zone legislation was going to be one of her first pieces of legislation. So it established 8,700 opportunity zones across the U.S. These are census tracts. They're thought of as kind of lower income, but they're based on 2010 census data. 2/3 of these areas have gentrified significantly since 2010. So don't think of this as, you investing into some really, really downtrodden area. There certainly are those, but a lot of these are kind of moving in the right direction. So what the legislation does, the incentives that it provides are threefold. The first is a deferral. To back up, you're investing gain, right? Capital gain of any kind, short-term, long-term, stock, art, whatever. And it provides some incentives around that capital gain tax. So the first incentive is deferral. So if I sell something in 2021 and it has a gain, and I invest the gain into a qualified opportunity zone fund, I do not have to pay taxes on that gain this year. That is the first piece. That is the deferral. I do eventually have to pay taxes. They allow you to wait until 2027. So those taxes from the capital gain that you realized this year will be due in 2027. But there's obviously some time value of money, right? In the 6 years between now and then, you can keep that money invested into something else, grow it. And so when it comes time to pay those taxes in 2027, you've taken advantage of the delay, because money now is obviously worth more than money later. So that's the deferral. That's the first incentive. The second incentive is the reduction. So if you hold your qualified opportunity zone investment for 5 years prior to when you owe the taxes in 2027, you get a 10% reduction in the capital gains taxes that are owed. So if you owed taxes on $1 million of capital gains and you invested, and that was recognized this year, and you invest that in a qualified opportunity zone this year, when you go to pay the taxes on that $1 million gain in 2027, you will only pay capital gains taxes on 900,000 of it. You get a 10% reduction in the taxes that are owed. That's the deferral and the reduction. The third one is the big one. It's the elimination, right? So, think Dr. Dre, DRE, right? So the elimination is any money that you invest in a QOZ, if you hold the investment for 10 years or more, any growth on that investment is totally tax-free, no capital gains. So let's say you invest, $500,000 into a qualified opportunity zone fund. And obviously there are rules and regulations around kind of like what the fund can do and how the money has to be used. But if you invest $500K into one of these funds, and it's a development project, let's say, and they build a brand new multifamily property, and it grows over 10 years to your investment being worth $1 million, you doubled your money and you don't owe any capital gains taxes. And that's like really the home run with this. The big piece of the legislation is that elimination, is that you can grow money, totally tax-free.
Yeah, and I do have a few questions or points that I know that I'd like you to point out for everyone. I guess the first one is OZs were, if you look at what the rules say, you would think that OZs were built more for developers to come in and do some ground up type stuff, right? Because there is a requirement of,
right,
if you buy something for $100,000, you have to reinvest at least $100,001. So,
right,
guys, when you're out looking at Crexy or LoopNet or whatever for properties, you're like, oh, opportunity zone for $1 million, but it's a stabilized property. It doesn't do anything for you if you can't invest another $1 million, right?
Right, and so in real estate, it's either going to be redevelopment or new development that is going to make the most sense, because there is a standard of significant improvement, because the idea here with the legislation was to improve some of these areas, and so they don't want people buying a property, slapping a new coat of paint on it, and recognizing these incentives. They want people to come in and add significant value to the community, whether it is development. We have groups that do ground up development. We have other groups that buy abandoned vacant properties and redevelop, whether it's self-storage or multifamily or whatever. But it just people love to slap the OZ thing when they're marketing. And a lot of times there's not benefit to it.
Well, Jason, gaslight swear, when I was showing you that investment, I was having trouble talking to the investors to say, like, should we make this an OZ or not? It was so borderline because there's also, if you talk to some CPAs, there's like this borderline rule of like what the occupancy is. Does it qualify you for 100% or not having to put in the equal amount of dollars? And it gets real weird.
Because the renovation budget wasn't big enough.
Yeah, because our renovation budget wasn't big enough, and it only works if TI would have been included, but you can't guarantee that every tenant wants you to roll the TI into the property. And that it got real difficult. So we actually passed on it because, the hoops we had to jump through. And I think, Justin, you could say right now that OZs are kind of still the wild, wild west, right? Like there's no case law against it or anything. And guys are just kind of firing at it. That's what I'm seeing, at least anyway. And I've heard it from a few other sources.
So there's, and it's funny. I mean, so I live in Florida too. Florida's kind of the wild, wild west, right? Everybody knows about Florida, man.
Everyone's got money.
Yeah, but it's funny because when this stuff came out, and we work with some groups that are very large, some real estate sponsors that are very large, and we're sort of involved from the beginning in some of the legislation and consulting and lobbying and stuff like that. So people are calling us, people that I know are calling me and saying, hey, like I'm trying to put together this opportunity zone fund, and they're asking me questions about it. And, I'm not the expert, and you're asking me questions. You're definitely not the expert. I don't trust you, to manage a fund for 10 years and abide by these rules. And and when it first came out, it wasn't fully fleshed out. And so, since then there's been other announcements and other legislation kind of put into place to flesh out exactly the mechanics of these things. And Biden is expected to, if he hasn't already, implement some additional, reporting measures in terms of tracking the impact that these projects are having on local communities and stuff like this. So it the lion's share, most of kind of the meat of it is in place, but there are still things that are changing and will continue to change, around that legislation.
Right. And I guess the last question on OZs is, well, there's a few other stuff. People were talking about time constraints, where the extent and everything else. But without getting into that, OZs are a little bit looser, comparatively speaking, to 1031s on debt, right? That you take on. If you're rolling your funds in, you guys could raise all the capital through private investors, or you could go take debt. You can take debt afterwards. You don't need. It's not as strict as 1031. I mean, is that a true statement? That's my belief.
Yes.
Anyway.
Yes, it's not as strict. You don't have to replace debt like you do in the 1031 exchange, right? You're only investing gain. You don't have to use a qualified intermediary. You can, and the dollars the term is fungible. I don't know they're interchangeable. If I recognize the gain in January of this year, say I recognize $50,000 gain, and I went out and I bought a new boat, and then later in the year I made some more money and I wanted to put 50 grand into an opportunity zone fund, I could do that. The dollars don't have to be the exact same dollars that came from the gain, right? It's all net at the end of the year.
Interesting. Hey, Scott, I want to go through your question in a second because it's a really good one. I think people are going to get a lot of value from that, but let's just do this one last one on opportunity zones. Probably from the same Facebook user. So if you put 1031 money into an opportunity zone, you have to pay those taxes on the 1031 that has been deferred, even if you hold the property for 10 years.
I'm sorry, my computer just popped up 6 different things at me. So if you put 1031 money into the OZ, you have to pay those taxes on the 1031. Put 1031. So no.
He exits 1031. Like he before this he did 1031.
Yeah.
Like,
right.
He bought a property, 1031 into something else. He's exiting that that next level, that 1031 to go put money into the OZ.
Right.
Is he going to tax then?
Well, you get taxed at that capital event there, selling that first rollover to then get into the OZ, I guess is what he's asking. Or can he go 1031 into OZ?
So with the 1031 exchange, your basis travels with you. So if you bought the first property, and this is going to be a little bit more context than just a straight answer, but if you bought the first property for $100,000, and then over the years you did multiple 1031 exchanges that initial $100,000 basis travels with you. So even if you end up later on with a property worth $2 million, your original basis was the 100,000 that you started with. And so you're going to be taxed on that original basis if at the end of the line, you don't do the next 1031 exchange. Now you're talking about a scenario where, you bought something, you did one or multiple 1031 exchanges. And now here we are today, you're looking to sell it. You want to do an OZ fund instead of a 1031 exchange this time around. So, like I said, you'll get the tax deferral, the tax reduction, all of those things will apply to your original basis, the original 100 grand from your first investment prior to any of your 1031 exchanges. But, so you'll get a deferral on that tax bill to 2027. You'll get a reduction on that tax bill, right? The 10% reduction. And then you'll get elimination of capital gains taxes on any growth. But in 2027, you do owe taxes. And in 2027, when you owe taxes, it's going to be on the gain from the original basis before all the 1031 exchange or multiple 1031 exchanges, if that makes sense.
Yeah.
If someone wants to follow, if you need to follow up with that with additional questions, just let us know. But
this stuff can get complicated.
I know.
And everybody's scenario is obviously really specific, and that's why we always say, all right, we're good. That's why we always say, talk to your CPA. And if your CPA doesn't know about 1031 exchange, doesn't know about qualified opportunities, then call me. I'll connect you to a CPA that we work with all the time, because it's not, it's not something that every CPA is going to know about.
Agreed. Let's go through Scott's question. I like this question. I think a lot of people can relate to this question because, they invest in some sort of partnership. Maybe they put up equity in a syndication or apartment building or maybe a commercial space, whatever it is. And, it's time to potentially sell. And some people want to stay in and some people don't.
Yeah. So we see this all the time as well and get a lot of questions on it too. So the drop and swap refers to a situation where you're in a partnership and you have a pending sale and one partner wants to do a 1031 exchange and the other partner doesn't. The drop and swap refers to the act of dropping out of the partnership into direct real estate ownership and then selling the property from that ownership structure and performing a 1031 exchange. And the reason why it's done is because you can 1031 exchange real estate. You cannot 1031 exchange interest in a partnership. So if I own 50% of ABC Partnership and ABC Partnership owns the real estate, I can't exchange my 50% of ABC Partnership. ABC Partnership can exchange the real estate, but there's a disconnect there. And so that's where the drop and swap comes in. I own 50% of ABC and the ABC owns the real estate. So what we do is we drop out of the partnership, and instead of me owning 50% of a partnership, I own 50% of the real estate directly. And my partner owns the other 50% of the real estate directly. And then you sell it in that ownership structure and you perform a 1031 exchange. Now there's some gray area around that. There's some risk of audit in doing things like that. I see it all the time. I'm not going to lie to you. People do it all the time. But there's definitely, some gray area there, and you're going to want to lean on, your attorney and your tax professional and stuff in those scenarios. There's also the alternative, which is the swap and drop, which is just the backwards, where, you perform the 1031 exchange while still in the partnership, and then immediately following you drop out of the partnership.
And speaking of which, Jason, does that clear that up for you? Or Scott?
Yeah, that was a little bit different than what I was thinking, but
what were you thinking?
Syndication, right?
Yeah, it's all right. I mean,
it's more of me and Jason owned a property together, and then something went sideways, or he wants to stay on, I want to get out, right? Like that's what. Yeah,
you guys don't like each other anymore. You don't want to work together anymore. Whatever the reason.
I got to get away from you. But no, that brings up a good point though. Of like, isn't there reverse 1031? Like when you talk about drop, swap, drop, like there is reverse 1031 exchanges, and like, what would you use something like that for? I know we're getting a little all over the place, but there's so much in this category. Sure. We could go on for hours.
So the traditional 1031 that people think about is the forward exchange. The reverse exchange is the scenario where you buy the replacement before you sell the property that you're selling. So you go out and you find, and whatever it is, you have a sale coming up. You know you want to sell, this property, and something comes up in your market that you just can't let pass by, right? But the property that you want to sell isn't ready to list yet. You have the cash on hand. You have to set it up with the qualified intermediary because you don't actually buy the replacement property. The qualified intermediary buys the replacement property for you and actually holds title to it during the exchange. But it's a scenario where you go out, you buy the replacement property first, and then similarly to the normal forward exchange, you have 180 days from the time that you bought the replacement property to sell the relinquished property. It's a little bit more complicated. It's a little higher risk. It definitely costs more money because the QI has to hold title for you for potentially 6 months. But it's a possibility.
Okay, so Scott followed up with this. Yes, he understands that, but how would it work in a large syndication when there are multiple limited partners?
Short answer, it wouldn't. Limited partnership is ownership in a partnership, and without that's without dissolving the partnership entirely. I don't know that you would be able to even attempt that. We tell people that a limited partnership is just not exchangeable, and when folks come to us in those scenarios with gains from a limited partnership, we tell them to look at the opportunity zone.
Got it.
But again, I'm not a CPA.
I'm trying to think through it related to he's using the term limited partner, but that might not necessarily be what they are.
So I when I hear the term limited partner, I think of like larger syndications.
Yeah.
Right. I think of hundreds of investors, invested in a syndication. If we're talking about a scenario where there's like 5 or 6 partners, or something like that, then I would say it's similar to the drop and swap scenario that I discussed with the 2 partners, where you would be, dissolving the partnership. And I've seen that done. I've seen the drop and swap done, with groups of like 5 investors personally. So I imagine it's something that, could be performed at larger numbers. But again, not a CPA.
Hey, Justin, so I do have a question. So whether you're 1031ing or you're OZing or you're DSTing, whatever you decide to do, you're moving your money.
Sure.
When you buy your new property, however you might do it in one of these tax advantage strategies, you still have all the availability of depreciation, straight line depreciation, cost seg studies. You still get to do all this other stuff that normally happens inside of real estate. Is it constraining you in any way moving forward?
So the DST specifically it's passive to you, right? So you don't get to decide to do the cost seg. Most of the DST sponsors use accelerated depreciation because their desire is to shelter the income for you as well. When you're performing a 1031 exchange, buying something yourself to manage, yeah, absolutely. You can perform depreciation, you get the interest pass-throughs, all that stuff. The piece to note, though, and it goes back to kind of what I mentioned about cost basis, is that if you fully depreciate a property and then you sell it and do a 1031 exchange into a new property, your cost basis travels with you. So you already fully depreciated the previous property, and so your cost basis in the new property is already fully depreciated. So you can get into a scenario where even though you bought into a new property, you have no more basis, and so you can't depreciate. Now you could lever up, you take on more debt, you buy more real estate, and now obviously that increases your basis. But for folks to get all the way down to 0 basis, is rare unless it's a property that you've held for a very long time.
And I see that's where like a DST could potentially step in if you're 1031ing because you're at the end of your career, you want to retire or something.
Right.
If you 1031 into a DST, you're getting involved into $100 million property. You're even as a limited partner, you're probably going to have some sort of stepped up basis in that situation that you're going to get all these additional benefits, right?
Yeah, because there's debt, there's debt associated with the DSTs as well, and it's non-recourse debt to the investor, which is nice. But there's debt associated, and so if you come in with $100,000 and it's a 50% LTV, then you're actually buying $200,000 worth of DST real estate, and so that's additional real estate that you can depreciate because your basis has gone up.
Now, what about in the sense that you 1031, or let's just say you own a property for a long period of time. I pass, I leave whatever we have here to my kids. Do they inherit that same basis that I left it off on? How does that work?
Yeah, so the nice thing about real estate, and the sort of morbid joke in my industry is swap till you drop. Right? We talked about swap and drop. The swap till you drop, which is you keep doing 1031 exchanges until you die. Your kids inherit, your heirs inherit at a stepped up basis. So your heirs inherit at fair market value at the time that you pass, which is obviously nice because they could then sell the next day and not owe any capital gains taxes. Now, they wouldn't owe any capital gains taxes. There are estate taxes associated with your passing, and the passing on of assets to your heirs. And so the property would be included in your, the value of your estate. But in terms of capital gains taxes, no, you get a stepped up basis to fair market value. It's just like stock.
Super nice. Yeah, that's super nice. That's a really good added, because let's be honest, if you're continuing to do these, the goal isn't to, unless you need the money for emergency purposes, you might be living on the dividends or whatever the cash flow is, but the goal probably isn't going to be to sell some of these things anyway. So that's a really added incentive.
So what's actually interesting about that, and there are a lot of misconceptions about the 1031 exchange, and part of that's, I think, why people have demonized it a little bit. One of the really interesting things is something like 60% of 1031 exchanges end with a taxable transaction. So the majority of 1031 exchanges that are performed, I'm not paying taxes today, but at some point in the future, I'm going to sell and I'm going to pay taxes. And that's surprising to people.
Yeah. And it could be a retirement plan.
Right.
Listen, the other thing is there's nothing wrong with just use it as just a disciplined way to save your money. Right. Because, they make $100,000 on this one, they make $500,000 on this one. Damn well, if that hits their checking account, they're just going to spend it on something else anyway. So it's a good way to keep it disciplined. You play the money game. So this question, for the most part, you can continue to roll over and over and over. I don't know if he means for fix and flips. If they're fix and flips, you can't do this on. They got to be long-term capital gain stuff. So rental properties, things like that. It doesn't work it would be great if it did, but unfortunately it doesn't work if you fix and flip a house every 3 months and you continue to just defer. That'd be great.
Well, I like the guys that are like, oh, I'm just going to hold this flip for 300.
Doesn't work. It's intent. It has nothing to do with it doesn't even really have to do with time frame, right? Because it's intent.
Jason, I'm impressed. Absolutely. It is intent, right? I've seen, and that's why there's gray area around it. I've seen scenarios where a guy bought a property with the intention of it being a rental, and 3 months, and 3 months later got an offer on it that was just crazy, just way overpriced. And you sell, and if you're ever audited, you say, hey, listen, I've rented this thing out. Every intention was to hold it long term, but I got an offer that was stupid. And so it is based on intent.
Yeah, it makes sense. Hey, Justin, real quick, sorry, because I know we're running up on our time limit. So if anyone has any other questions, feel free to shoot them down there. Justin will follow up. Can you 1030, like, let's say you're in a syndication deal, like the money we raised for our apartment building, we don't 1031, we all go our separate ways. As a limited partner, can you 1031 out of that into another one, a DST, into another syndication, or whatever it may be?
No. So the partnership itself could perform an exchange, but the limited partnership interests, are not 1031 exchangeable.
So it's all or nothing. Is that what you're saying?
Yeah. So if you guys, so if you guys as the GPs, for example, got a crazy offer on, your property, your self-storage property that you guys, redeveloped or leased up, value added, whatever, got a crazy offer in it. And you call your LPs and you're like, hey guys, listen, we got this offer, we can totally cash out, or there's a property down the street that we really like, we can 1031 exchange into that. The partnership itself could absolutely perform a 1031 exchange.
Right.
If you're gonna cash out and distribute, gains and principal back to investors, they're not going to be in a situation where they can perform an exchange.
So that's probably your scenario, right, Ian?
Yeah,
on
exactly.
a lot of the buildings that you've done.
Yeah, no, if we all decided to go our separate ways, that someone didn't want to follow, if we decided, hey, we didn't want a 1031, what could guys do? And I think that's potentially someone get into an OZ fund, or they could potentially get into a DST or whatever it may be. I guess the one last question is, if you 1031 out of your rental property, you say, I've had enough of this, and I want to get into an LP situation, or I want to invest in this multifamily deal, can you 1031 into a share of a syndication
of real estate? Yeah. So before the DST, there was a entity or a structure called the TIC. You probably heard the term tenants in common. But essentially, if you guys structure it in such a way that, Jason buys 30% of a building, Ian, and you bring the rest of the capital, and you guys could have some sort of agreement in place that Ian's the one that manages it, that's kind of separate from the real estate ownership itself. You can absolutely purchase a fractional interest, so long as you're purchasing actual, real estate.
Nice.
Yeah, that makes sense. I mean, honestly, this has been the best hour I think I've done in a while after last week's show, because it's like I have all these questions.
Well, it's so relevant. It's so relevant to you right now, which is good. It's helped, right? And it's great. No, Justin, we really, really appreciate this. This is we got some really good feedback from people, so I'm glad. Why don't we do this? Let's just leave everybody with your contact information.
Sure.
So everyone knows exactly how to find you. Obviously, I think you proved that you're an expert in this space. So, if anyone has additional questions,
your words. I'm not allowed to call myself.
That's a bad word. That's like when I used to raise capital. I wasn't allowed to use the term safe and secure.
Right. Nothing is guaranteed. Everything has risk.
Years ago when we were in the capital raising phase, it was like, nope, can't use the word safe. Can't use the word this. We're like, well, what freaking word are we allowed to use? So, Gotcha.
No, but I mean, my contact info, I don't know if there's a caption where you guys can put it or whatever, but 1031dst.com, 1031dst.com. You can check out our website. If you're accredited, you can check out, some of the properties that we have available. That's my name. My email address is jkiehne@fortitudeinvestments.com. So that's just first letter of my first name, last name @fortitudeinvestments.com. And I got a 410 phone number, even though I live down here in South Florida. That I don't know if you guys want to put that up on the screen or what.
Sure.
You go ahead.
Load it up.
410-703-6680. Give me a shout. Shoot me a text. Keep the nudes to yourself, please. But happy to chat. Whether it's questions about tax deferral or 1031 exchange or opportunity zone or just whatever. We see a lot of things, and if I can't help you, I can probably point you to someone who can. Because we just do a lot of networking in the real estate investment space.
Nice. And if anyone wants to rewatch this video, it's on multiple Facebook pages, multiple Facebook groups, LinkedIn, YouTube, everywhere in between. So this is the replay link, right? It's live. We're doing this live. Just go back to it, watch it, rewatch it. You can scroll through it. If anyone has any other questions that potentially come up, you can always comment through this thread, through this feed as well. And we can hop on, tag us individually through it, and happy to go through it. So yeah, Justin, appreciate your time. I think it was
awesome.
Got a text here from one of the viewers. A Facebook user that kept asking questions. He says money, Mike Casey.
I love it.
Enjoyed it. So.
He hid behind his face Facebook user.
Sure.
Yeah, so
all good. All right, man. We appreciate it.
For sure.
Thanks again.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.